and they say, you know what, I'll buy you out. So most likely, you will only save your investment, get the money back, or you make a tiny okay.
We are back with our masterclass about how to become an angel investor. And now we're headed to the 6th episode.
The last one.
The last one. And today we're going to talk about 8 different ways that you can exit your startup. We call it the get rich moment. And you do not want to miss this one because some strategies will be really, really good and some strategies will be catastrophe. So stay tuned because in this episode we will present both bad and good ways to exit your startup.
Yeah.
So this is going to be so interesting. And we have the business lawyer, of course, with us. He's going to take us through.
Yeah. And when you say good and bad ways, you mean like amazing, get rich moments, and catastrophe. Lose your entire investment ways.
That sounds like a catastrophe.
Yeah.
So let's start.
Yeah. So number 1, the most common exit of the positive ones will be a trade sale. You sell your company. Often you call it an M&A deal, mergers and acquisitions. We're talking about the acquisition part here. That means that a bigger company buys your company.
The whole company?
Yeah, the whole company.
Oh.
So as long as that sale, that the acquisition is done at a higher valuation than the one you entered into, you will make that return of investment. So that can be anywhere from 2x your investment to hundreds of x in the unicorn situation.
So it can be a really good deal.
Yeah. And that's what you want. As an angel investor, you enter in so early at such a low valuation. And what's good to know is that when that type of exit can occur will be dependent on a large part if you have brought in venture capital money or not. And that is, if you bring on venture capital money, then you will need the valuation to be much higher before it makes sense for them to allow that exit to occur. So, if you bring in VC money, which is good for you as an angel investor to talk with the founders about in the beginning, what's their aim, what's their goal? They cannot promise that they will do the venture capital journey, but you can know what they're aiming for. Then it's higher risk, but also even higher reward. If they're looking for a more decent type of sale, it can be a 10x. They sell their company for 100 millions. Or instead of billions, which means that you might make a 10x or 20x or 5x. So that's a bit lower risk, but the return of investment will be lower as compared to the venture capital journey.
Okay.
But that's a typical, the most common will be the acquisition, selling your company, being bought by another company.
Yeah, and you call it trade sale.
Yeah. Typically that will be somebody who's in the same type of industry as you. It might be Google buying a tech company. It might be a big pharma buying your health tech company. If you're in food, it might be Walmart buying you. Who knows? So something like that.
It's a dream scenario.
Yeah, because they're looking for the innovation, the creativity that's hard for them to find within their own research and development only. I mean, if they're looking at the startup world, they suddenly have the whole world as their menu to choose from. So that's kind of the name of the game.
Trade sale. We're moving on to the next way. What is that?
The next way will be the IPO. That is the golden standard, the dream of most founders.
Tell me more about it.
Yeah, it's getting, you go to the public market, to a stock market, to the exchange, the initial public offering, the IPO. And that typically will mean a brilliant return, a brilliant get-rich moment for you as an early angel. But what you need to think about is that typically in the IPO, once you go to the stock market, there will be a lock-in phase, which means that even if the valuation, when you get publicly trading is much higher than the valuation you entered into, you will be locked in, so you're not allowed to sell your shares for a period between 6 months and 24 months. And in that time period, guess what? The stock can plummet. And that has happened many times.
So you can risk lose your money in that case.
Absolutely. If you're still locked in and you cannot sell at that top when the IPO happened, and it does not go up as you all count on and hope for, but instead it plummets, absolutely. And also be mindful that an IPO, not all IPOs are those big grand IPOs on the New York Nasdaq Stock Exchange. They can be on a tiny, unregulated market in Stockholm. So, and then the liquidity will be much, much lower and the risk much, much higher. So be mindful that just because you were talking about the IPO, it might not be that get-rich moment for you. So watch out a bit also.
But is it mandatory to do that lock version?
It's not mandatory, but most exchanges will demand that from the company. And the reason is that is a protection in relation to the public that gets offered your shares, that you have not inflated the value just to run off the day that the public gets access to your shares. So it's kind of a promise that you have skin in the game that the valuation will uphold.
Okay, then I understand. Thank you. So, and the third way?
The third way will be a secondary sale. That means that the company does not do a proper exit, but you will exit. You will sell your shares to somebody else. It can be in relation to a new funding round when the new investor coming in wants to top up their total ownership. Typically, when you do a secondary sale, it will happen at a discount compared to the valuation at the new funding round. So watch out for that. Be mindful. And also have a look at the shareholders' agreement, as we talked about in another episode. Because typically there will be restrictions on the transfer. So you cannot go about promising to sell your shares to anybody without looking. Is there a right to first refusal, etc., that you need to adhere to before you can sell a secondary sale?
Okay.
And typically, this is a okay get-rich moment. It's not the wow get-rich moment, but it's a good get-rich moment. And typically, it can happen much faster than waiting for the company doing a proper IPO or getting sold in its entirety.
So that was a secondary sale?
Exactly. You really sell your shares on a secondary market to another shareholder, another buyer.
Okay. We're moving on to the fourth one.
Yeah, and that's a bit more unusual. That would be the merger. We talked about the M&A, and we're going to look at them separately here because they do warrant that. The merger will be that your company merges with another company. So they merge together.
Okay.
And typically, often that can be a cover-up because it's actually acquisition, but you call it a merger to kind of keep your pride. But anywho, the merger will typically mean that you, as a shareholder in the company that's getting merged, will not get cash in hand. Instead, what you will have is shares in the surviving entity. And if it's not your company, it will be the other company or the new entity that will hold both companies.
So you come along to the merge? Okay.
Yeah. So first you hold shares in your startup, and after the merger, you hold shares in a bigger company. That's the combination of the two companies. So it will not be a proper exit. That means you have cash in hand, but you will exit that startup for something bigger.
Okay, but why is it more uncommon to do like this?
Good question. I think it's just easier to buy a company. More straightforward, because typically one company is stronger than the other. And if you want a quasi-merger, even if it's an acquisition, you can pay in part with shares in the buying company. So it's kind of, the difference between the two is kind of new, it's floating.
It's floating.
Yeah, it's not a clear cut, and that's why you typically call it M&A, not acquisition or merger. But here, to make sure you really grasp the name of the game, we've separated them to really explain.
So the fifth one.
The fifth one, this will be when you do not sell the company. You keep your shares as a baseline, but instead, if you have a tech company, you will license out the tech, or you will sell the assets of the company.
Okay, so not the whole company, only the assets.
Yeah. The part that's actually valuable of the company will be sold out in some way or form, so that the entity that you hold shares in, the startup, will gain cash or value instead. And then either you liquidate that company and get the cash in hand, if it's an asset sale, or if it's a licensing, you might pay dividend ongoingly. And typically, this is also okay get-rich moment, not the great get-rich moment. It will be less of a good return of investment compared to the acquisition, getting bought, or the IPO, typically. So it's a more complex way, but still it will get the company some kind of revenue and you some kind of return of investment, hopefully.
Hopefully. So now we're at the number 6.
Number 6. And that will be the buyback. This is when the founders turn to the early angel investors and say, you know what? Typically, it's because the company is not going as good as planned, because you had this brilliant plan, right? And they say, you know what? I'll buy you out. I'll buy you out, so I will own the company. I will run it my way. I will do it my way. So most likely, you will only save your investment, get the money back, or you make a tiny, okay return of investment.
Okay. So in that case, why do you get sold out?
Well, typically the company is kind of stagnated, and you don't see a chance to get a really good return of investment, a really great exit. But the founders still believe in the company and take ownership over it and want to kind of restructure it or just run it and make it more solid as it is. Or it can be that you and the founder have a conflict. It's something in between you two, so you're not really working out. So the founders say, you know what, it's better we go part ways. I'll buy you out. What if I give you 1.5 of your investment back? Is that a deal? Something like that.
Okay. And the 7th one?
7th one will be a liquidation or bankruptcy.
Bankruptcy. Doesn't sound so good.
No.
So explain
This
it.
is the bad. We talked about liquidation when you've done an asset sale. Now we're just talking about liquidating the company, selling the assets either voluntarily or mandatory, because you cannot pay your bills in time, etc. Or bankruptcy. So it's a kind of declining scale we're talking about here.
Okay.
Anyway, not good. Most typically, you will not see a dime. If it's a bankruptcy, it's over.
It's over.
It's over.
Time out.
Yeah. Most startups do fail. Ouch.
Yeah, they do. It's a harsh reality.
Yeah.
So the last one.
Number 8.
Yes, we're at number 8 now.
And this is one that you might not hear about that often as an angel investor. But that is actually that the company does not manage to get an exit, but it's not failing as a bankruptcy. It stays a private company going okay.
And nothing special happens.
No. And that can be either frustrating, because you can't really find a liquidity event, you cannot sell, you cannot get a return on investment, or it can be great. It might be a steady growth. It might pay dividend every year. That might even be better than a one-off exit. So it might not be as boring as it sounds that the company sticks. It's just important to know that you can get your return on investment some way. Because even if you want to do a secondary sale, if the company stays private, you need to show that buyer why they would want to invest. How can they get a return of investment? And it often happens. A company goes okay.
The company goes okay. And it's a good one too. I mean, it's not bad.
No, exactly. As long as you don't lose and you see some kind of dividend or something that makes it worth it. Because you don't want to put your money in and never see it again and just wait. Right?
But is it a good long-term strategy to find a company like that?
If it pays dividend, yes.
Oh. So you get money every year,
yeah,
or you know.
Because otherwise, again, you put it in a hole and you never see it. But if it gives you something back ongoingly, it can be brilliant.
Yeah, I imagine for you, maybe you do a big profit in the end. That
Absolutely.
way. That's really good ways.
Yeah.
The get rich moment. We talked about 8 different ways how you could exit your startup.
Yeah. The truth. So the good ones and
the bad ones.
Yeah.
But I mean, anything can happen, and we hope for the big money for you guys.
Yeah. And also, once you heard all of these 8 ways, a good thing would be for you to look at them and talk to your investor. I mean, even share this episode with the founders or other angel investors who you're talking about doing a deal with, and discuss, okay, so where do we see ourselves? Even if you're already in the game, talk it through. What's a proper exit strategy for us? And some people say that every founder should have an exit strategy day one. Some people say, no, they should focus building a strong company, a solid company. The truth is somewhere in between. But looking at all of these options, talking it through, thinking it through, where are we? How can we navigate to get where we want? That can be really helpful.
But is it common to talk about the exit strategy in the beginning on the investment? We talked about it on the checklist.
Yeah. And I'm going to say it's really, really different. Different investors see it differently. So it's kind of hard for a founder to know what to answer when they get the question, because some people hate it when the founders are super exit. We're going to flip the company in 2 years. And some people love it. They say, oh, you have a clear exit strategy. You know exactly that it's Google who's going to buy you. So find your way, find a middle ground, be realistic, do talk about it. But talk about it when it's appropriate in an appropriate manner. And first and foremost, think about it in relation to your own finance and your own investment goals. Where are you at? High risk, etc.
Really good. Thank you for explaining to us.
Thank you.
And I hope you really learned from this, because I truly do. It's so interesting. And I hope your businesses are going so well out there.
We do.
And do share our channel to your friends and to your colleagues and people in your branch, because we're going to keep sharing this business law knowledge. Now you listen to the 6th episode of How to Become an Angel Investor. So now you can just start your journey.
Good luck. Stay tuned.
Good luck.
Hej då!
Hej då!